Hello, everyone. This is Gonzalo with Maple Capital Partners.
And this is Mark with Maple Capital Partners.
So thank you for joining us once again. Today, we want to go over with you folks what are cap rates, how are they used for, and give you some quick examples of how they fluctuate from deal to deal. So kick it off, Mark.
Absolutely. So first of all, we're going to go through the textbook definition of cap rate. And what do you hear in investment circles, investment books? Whenever you look up cap rate, it's the return that you get if you paid all cash. So number one, we think this textbook definition is absolutely garbage. It's not, in fact, the return that you would get if you paid all cash. It doesn't factor in closing cost, capex cost upon takeover, any of that stuff. And so we want to thank Brian Burke at Praxis Capital for kind of talking a little bit further about this in his book, Hands Off Investor. But basically, cap rate should be thought of as a measure of investor sentiment in a particular market. It is how much investors are willing to pay for a dollar of income. So that is, the lower the cap rate, the more that investors are willing to pay, by and large, across a market. Now, how it's calculated? It's simply NOI, or the net operating income that a property is throwing off, over the purchase price. I'll give you a real world example here. So in this case, we've got asset B, which you purchased at $4 million. It's a stabilized asset, so there's no capex that goes into it. And you're buying it stabilized, as I said, so the NOI is 240 grand. That means that the going in cap rate is 6%. So that's a really easy example of how to calculate cap rate.
And to kind of dive a little bit deeper into cap rates and how they fluctuate from market to market, it's important to understand your different types of markets. So the three different types of markets that are out there are basically primary markets, secondary markets, tertiary markets. Your primary market is going to be the LAs, the New Yorks, the Boston. These are going to be historically very low cap rates because they're just very stabilized cities. They are not going to really be seeing a large downturn anytime soon. Very secure places for investors to invest their money, therefore the returns are going to be much lower. Then you have secondary markets, which are going to be the Nashvilles, the Louisvilles, the Charlotte, Raleighs. These are all up-and-coming cities that are growing rapidly, not as stabilized as the New York cities or the LAs. Then you have the tertiary markets, places that are much smaller than secondaries, outside secondary markets, places like Columbia, Tennessee, places like Allentown, Easton, Pennsylvania. These are areas that are much smaller, where you can typically and historically see higher cap rates, but things have been changing for tertiary markets.
Yeah, absolutely. And as Gonzalo mentioned, as you go down the spectrum from primary to tertiary, you would expect cap rates to go up because as the markets get smaller and you get further from some of these larger metros, you would expect that the returns should be a little higher. You should be compensated for the risk that you're taking. What we've seen in the market today, in a super competitive market, is that these differences in cap rates between tertiary and primary markets have really declined and compressed very, very much so, because investors are willing to take more risk for a particular stream of income. And so as a result, you're seeing those smaller markets do particularly well versus primary markets and secondary markets.
And to reiterate, as your cap rates go down or as your cap rates compress, you're going to be paying more for that asset versus if your cap rates are higher, you're going to be paying less for your asset. So it's important to understand that. Now, also within those markets, you have different types of investment assets, so different classes. You have your Class A apartments, which are typically the stuff that you guys have been seeing that's newly built, have a variety of amenities, pools, gyms, dog spas, things like this. These are considered Class A apartments. Now you have Class B apartments, which is a step lower. Anything between 1970 to 2000 to 2010, these can be considered Class B apartments. Class C apartments is the lower of the rung here. So anything from 1970 construction and lower can be considered a Class C apartments. Now, there's also another way to classify your classes, and you can do it by tenant base. So a Class A apartment could be considered perhaps maybe a white collar apartments, people working in the work from home, the offices, the high level positions of companies, higher salaries. Your Class B perhaps could be the workforce housing. So perhaps your middle to lower income bracket can be Class Bs. And then you have your Class C apartments, can be seen typically maybe as a Section 8, majority Section 8 apartments. And that's a way to classify it versus based on your tenant base.
Absolutely. And there's no real specific rule here. These are just general rules of thumb and how we think about these different classifications, whether it be the year of construction on the quality or the year or the quality of the tenant base. So just keep that in mind is everybody's going to kind of have their own classification as far as what they say, class B, class A, class C. And typically you'll see brokers try to oversell this point when you're looking at particular deals. So they may look at a deal and say, this is a class C property in a class A area, and you'll have to really think hard about whether or not that meets your definition for class A. And then the last qualification or the last way to look at cap rate is really asset specific. So a particular asset could have its own story that makes the cap rate on that particular investment much lower. So for example, something like there's a property with an empty lot across the street where you know that there's a ton of development coming in, maybe a Walmart and a bunch of convenience stores and things like that. That may have a lower cap rate than the same property in a different location without all that development going on nearby. So that's something where it's not really captured in the asset quality or the tenant base or the market itself. It's more asset specific that dictates that cap rate.
So now we gave you folks an understanding of what cap rates are, how they use in different types of asset classes out there. So the next one, Mark, is going to go through the shortcomings of cap rates because, as we're going to go over in a minute, they can vary from assets that are stabilized versus assets that are unstabilized. So, Mark, you'll be showing some spreadsheet on an example here.
Absolutely. So where we feel that most of the industry gets cap rates wrong is in its application to unstabilized assets. So cap rate, as we said, is a snapshot. It's a snapshot of how the property is operating, a stabilized property at a point in time. It doesn't tell you or it doesn't help you pragmatically look at a deal that may be unstabilized. We're going to give you an example of where this breaks down. So asset A you're evaluating versus asset B, let's say. You've got two options to invest in. Asset B is very stabilized. It's 98% occupied, it's at market rents, and you're paying $4 million for that. The stabilized NOI is 240,000, and the cap rate, as we mentioned earlier, is 6%. Versus asset A, which you're paying the same purchase price, $4 million, but the NOI when you purchase the property, the unstabilized NOI, is only 50,000. However, you know that by putting in 200,000 in capex, you can get to a stabilized NOI of 320,000, so higher than the stabilized asset itself. So looking at this deal using just cap rate alone, you would say, okay, I can get 1.25% here versus 6% here. I'm going to go with asset B. It's a clear winner, much higher cap rate. But that would be missing the point. Your unstabilized asset is going to have upside. So you want to know whether or not you're paying too much, too little, or just right for that upside. So in this case, we use a metric called yield on cost. And what that is basically the stabilized NOI. In this case, you're assuming $320,000 is going to be your stabilized NOI over your purchase price plus the capex that it takes to get to that stabilized NOI. So 4 million plus 200,000. That comes out to 7.62% in this example. Now, the key question you have to ask yourself is that enough? So you're getting a higher yield on cost than the market cap rate, and that's great because the last thing you want to do is put all this time and energy into renovating these units and getting up to the stabilized NOI, and then you're only getting the 6% cap rate that you would get on any other asset. In that case, you might as well just buy a stabilized asset and save yourself the energy and the risk that it takes to do that value add program. In this case, you are getting some upside. That upside equates to $1.33 million in value creation. How do we come to that? It's the difference in the NOIs here, 320,000 minus 240 divided by the cap rate of 6%, and that's 1.33 million. Another way to calculate this is basically look at NOI divided by your market cap rate. We'll say in this case 6%. That's 5.33 million, and you paid 4 million. Therefore, you've created 1.333 million in additional value to the property. So with this, we feel is a better metric, and it's a metric, by the way, that's used widely in the development world. So ground up developers, they'll look at this as a way to measure whether or not they're comfortable with the risk of doing a ground up project. Because again, if they're doing ground up, there's no building there. There's no NOI. It's unstabilized by its very nature. So they want to know, am I getting more than the market cap rate? And am I comfortable with the difference here? In this case, 1.6% difference in what you're creating versus what the market is.
Great. And I would definitely say that asset A there is a value add. Great. So now that everyone kind of has a good idea of what cap rates are, how they use, and the different classes of assets out there, we're going to give you a quick background understanding of how we use cap rates. So the first one really is as a sanity check in order to determine if we're paying too much for an asset in a particular market. So every market has a general accepted cap rate, and we want to make sure that whatever we are buying this asset is, we're close to that cap rate, meaning that we're not paying too much for this asset compared to other property that's sold for a similar cap rate in the area.
So the next application that we're using CapEx for is really to see what value we're creating with a CapEx program. So we'll look at a particular deal, just like we did in the last example. We're looking at two different assets, and we'll say, okay, we're putting in a certain amount, we're getting a certain amount in higher NOI. Is it worth doing this CapEx project? And it'll help us determine how much value we're creating. So it'll actually inform our business plan. That is, it'll help us determine how we're going to proceed with the deal itself.
And the next one is, I would say, one of the most important pieces of this is really the exit cap rates, or you've also heard of it as the reversion cap rate or the terminal cap rate. This cap rate really drives what the returns our investors are going to be getting, because it really gives it's a number that we have to estimate and assume what it's going to be like 5, 6, 7 years down the line, because it has such a great effect on the sale price of the building. As mentioned, the higher the cap rate we input into the model, the lower the purchase price. The lower the cap rate, the higher the purchase price. So we have to come to some sort of agreement of what that exit cap rate can be, and we use it as a rule of thumb. So we like to add 10 basis points per year, or 0.10%, in our cap rate. So if we bought it at a 6, if we're holding it for 5 years and we use it in 10 basis points per year, we're going to be putting in the model 6.5% cap rate or 5.5% cap rate in our model. And Mark is going to show you a quick understanding of a stress test that we use in order to determine what that return would be, depending on what the outlook looks like 5, 6, 7 years down the line.
Absolutely. So the future is inherently uncertain. So as a result of that, we try to look at what is the realm of possibility. That is, what are the likely scenarios we'll face in the next 5 to 7 years, however long the hold period is, and are we comfortable with the returns that we would get under those different scenarios? So I'll go now into what that stress test looks like. So this is a real world sensitivity analysis that we did on a past deal where we looked at, okay, our base case is 6.5%. For this particular deal, it's a 5-year hold. Our current market cap rate is 6%. So as Gonzalo alluded to earlier, we added 50 basis points to the cap rate, and that's to be conservative. That's to say that our base case is that the world will look a little bit more pessimistic than it does today. That is, investors will pay a little bit less for a stream of income in the future. So 6.5% is our base case. And then we look at, okay, what happens under different scenarios? So in the scenario where maybe we're off and there's upside, an upside surprise, cap rates maybe go to anywhere from 5.75 to 6.25. What do the returns look like, and are we comfortable with those? And then on the downside, which is, I would argue, more important, is what's the worst case scenario? In this case, we felt that the, I guess most likely, in this case, we felt that, things would get to potentially 7.25% cap rate on the exit. And are we comfortable with these returns? And again, this is all just to inform us of what are the likely outcomes on this particular investment, and are we comfortable with them? So in conclusion, we've talked about what cap rates are, that is the textbook definition, and why we feel that that is inaccurate. We've talked about how cap rates differ based on the market, the tenant quality itself, and the year of construction. We've talked about how we use cap rate and why we feel that cap rate is inappropriate for unstabilized assets, and why we feel that yield on cost is a better measure. And we've talked about some of the real world applications that we use cap rate for when we're evaluating deals. So as a overarching theme for our presentation is basically that cap rate is just one measure amongst many others. We feel that the market or the industry gets it wrong in that cap rate is by and large the sole metric that you should look at, or it's the most important thing. we don't feel that that's the case. It's just one of many tools that you should use when evaluating deals.
To conclude this, thank you everybody for joining us. Once again, we hope you learned a little bit more about cap rates, different markets, and multifamily assets. And as we always close it off, be kind, be charitable, and invest wisely.
Thanks. See you all next time.
Thank you.